All right. Hey guys, how you doing? Happy Saturday. It's not snowing today, which is good. Just introduce myself. So I'm Mustafa Khanbhai. My company is Seamlessly. We're intersection between a venture consulting and a venture partner. But Oliver and Nico asked me to speak today about what investors look for. And I thought, it could just be a bit of an open dialogue. Maybe share a little bit about my experiences to date, the journey I've been on. So a bit of background about me. I've been in different facets of investing. I started off my career at Mars in their M&A team. So I was investing on behalf of a family office. That's Mars, the candy company. So we were looking at companies to buy, and we had a very specific criteria for the family that they look for in investing in that way. Then I was at Virgin for about 5 years. So I was working in the family office for Virgin. So we invested in existing companies, but also Richard Branson would come to us with ideas and areas that he was looking to invest into, or that passion to him, and we would then look for ventures to look at, and we had some criteria there. Then I was with Uber in the last sort of 4 years of my corporate life. So I scaled Uber, moved to Manchester here with Uber, and launched and scaled them over about 4 years across the UK. So that's more operating role, but I can give you when you're in the midst of a fast-growing company. And then since then, I left in 2019, and I've opened up my own consulting, and I work with a lot of scale-ups. So I'm building up my own portfolio. So I work with companies in the e-commerce marketplace space, but also with a sustainability angle there as well. So I've invested in companies, but also been pitching for investment, so I can give you a feel for what VCs look for right now. So that's just a little, very brief background about me, and I've been fortunate to have quite a varied career in lots of different areas, with some great brands, and then also build my own companies. And hopefully I can share some of those sort of insight with you. But before I kick off, maybe I'll ask the question to yourselves. What do you think investors look for?
Return.
Return, one. Yeah.
Why? Did you have to ask?
Return is one. Yeah,
Yeah.
yeah.
Right. Got it.
And when you're thinking about return, what does return mean? Something very different to everybody. What does return mean for
It
you?
could be something that they feel very passionate about personally. Could be something that they agree with, like a sustainable aspect of business or development. But yeah, I guess all these little things.
Absolutely. Return could be give back, altruistic, and it could be monetary as well.
Yeah.
The team, the founders, how well they get along, if they have maybe worked in the past together before. So to see, if this team can actually last long term. So just look at the co-founders of the team,
Absolutely.
their abilities.
Founder, team, capability there as well, for sure. Anything specific, do you think, like if you were an investor sitting there, what would you sort of be looking for in that?
I think I would, I don't know who the fuck am I, but I think I would just see if they have been known each other for a long time, if they have worked in the past on something, else maybe like a smaller project.
Execution, credibility, yeah.
Exactly, some kind of experience. So, can they work well? Because it's quite a big commitment if you try to build a company. So I want to make sure that these two people are comfortable in working together. Maybe they went to university together. And, so I think I would, because I genuinely feel like a team is much more valuable than maybe the actual idea at the end, because then again you can try to pivot or do something else. I think it's valuable to have a very strong team. It's very difficult to find people who can work together. So team is, I think, that in general, group work. If you have a shit group, you can't do shit. It doesn't matter how competent everyone is. If you can't work together, it will fail. So definitely just their relationship as co-founders or as a whole team and how they get along.
Great, yeah, really good point. So more the gelling, the dynamics, etc., and how that could iterate with the idea, return we had. Any other thought?
It's sort of back on to that point. So my team, it's essentially like a one-man team at this point. I am looking. Do you look at like a team with only one person in and ask why, or do you see it as a blank slate, or is it?
Very, yeah. There's no. I think we'll get to this. There's no one answer.
Yeah.
Any other thoughts?
I think like scalable opportunities. Like you might have a good idea, but can you keep growing it?
Scaling. How do you guys unpack scaling? What do you guys think look for in scaling? What do you think? If you're again an investor and you're thinking, can this thing scale? I'll give you two. It's a leading question, but There's two areas I'm thinking of. Potential, it could be market size. I don't know if you guys have heard these words being bandied around, TAM, SAM, all that type of stuff, right? Basically addressable market, the playpen you're playing in, how big is it, right? That's one area. Anything else?
Maybe like associated markets, if you built your company and then like slightly tailored it to other segments in the same sort of place.
Adjacencies, yeah, maybe seeing has it worked elsewhere. That could be, just to be able to see if it's actually been executed in that way. Anything else in terms of scale?
Size of the opportunity extra to the size of the market, customers, different geographies, longevity.
TAM, SAM, yeah. I guess if you take SAM and TAM, so it could be total addressable market. So whenever people put these charts in, you sort of see these big circles in there, and they'll be like, go smaller and smaller until you find the area you're playing in. TAM could be the total addressable market. So maybe let's take food delivery. Could be the whole total addressable market. Within that, you've got maybe food delivery, so Uber, and that sort of coming through. Within that, maybe you've got, I'm focusing on 15-minute delivery, quick commerce, right? So that becomes maybe a smaller area. Or it could go the other way, right? It could become, because that could be any product versus just food, and then food could be super smaller. So I guess it's looking at the total space, but then the area you're going to play in within there as well. Anything else? So we've got size of market, we've got ability to scale, we've got return, we've got founding team.
How much they've done before asking for money.
So current performance as well, track record as well of what you've delivered.
Maybe I know some people like IP and whether they can be like the exclusive ones to pursue their idea.
Due diligence on how protected and how defensible, or they call it a moat, right? How much of a moat is around what you've got there as well. So again, is it unique patterns, something specific within there as well?
Diversity perhaps within founding teams.
Yeah, I think that's becoming more and more an important topic for a lot of investors. Want to make sure it's a diverse team, because diversity brings in differences of opinion, different ideas, etc. as well, and it's much more open as well. Cool. You guys have answered my questions for me. But so basically, a lot of these are the core points, and I think it's not one answer for everybody. It flexes, it changes, and that's why I want to sort of reflect back in my journey. So if I take when I was at Mars, when I was at Virgin, when I'm either looking at pitch decks that get sent to me, or if I'm actually pitching out, it's an element of all of these components, but slightly dialed up or dialed down. So at Mars, it was all about, we want to be, so my particular product was a natural organic, and we're looking at bars, just candy bars, another line, another adjacent line, and they were like, well, how can I be super big in that category? And is it going to be $1 billion brand? Because it's a big beast. So they're looking for brands out there that have the potential to scale, to have the potential to be able to work in that particular area, and actually brand story, because that's something they can't create. So it's like the founding team, what's the passion, what's the mission, what's the story behind it? Then have they got a run rate? So have they shown that they've started giving that sort of projection coming through? And then what's the area that they're operating in? And can I show that if I get it into all of the Tesco's in the UK, or if I get it into all of the Kroger's in the US, or into Costco, how will this product rotate? And the way they get that is from run rate data. So previous data that may have. So they can see, well, if I put this in a typical store, I can sell this many bars every week, and I know that's my formula. And I know this is my profit for the product because I've done my element of it. I can make it this more efficient. Now, if I get a deal where I can get it into all of the Costco in the US or around the world, I know that this brand can get to that much. So they look at it in that potential to see demonstrated traffic. Virgin, very different when they're looking at businesses. They're looking at it, their criteria is very focused, 5 criteria. First and foremost, is it fun? Does it champion the customer? Can it be 100 million business? That's your rate of return. That's what they look for. And is it sort of shaking up and disrupting the market overall? So, I mean, you can focus on those first 3, but that was actually religiously we would look at that, because that was the Virgin brand values. Is it fun? And you know that, right? With a Virgin brand, is it, I think it's probably lost its way a little bit recently in the last few years, but previously it's very much been about, can the business sort of work in this way? The championing the customer was the fundamental piece, because there no IP, for example, potentially, but it's more about re-engineering the customer experience and doing things differently. And that's when you're sort of reinvesting your money and doing it differently. And when the brand did things like Virgin Brides, Virgin Cola, it lost its way. It wasn't doing that fundamentally differently. But when it did maybe gym memberships, when it did banking, healthcare I worked on, it was again changing that experience. And when there's a human element to it, the Virgin brand comes into place. That's those values there. And now bringing into the VC world, and if we're pitching, so one of my companies is an e-commerce platform, a dropshipping platform. It's 2 years in, it's scaling quite nicely. And we were pitching to VCs last year, went out to the whole network and pitch. And we're 2 years in, so we're lucky. We've got a product. We'd raised some seed capital. So I heard in the previous session looking at raise of funding. So our founder had already raised about 1.2 million, bootstrapped a lot of it himself through his own business. So had that credibility, had built 2,000 websites for companies, and then thought, right, I want to create a platform of my own here. So he had some credibility in the background, raised some money, put it together and launched it and running it through. And when we're going to VCs, it's very interesting from a VC perspective. They're quite specific. They're like, have you got 1 million ARR, right, for that type of business? ARR is annual recurring revenue or monthly recurring revenue. I heard mentioned before your speaker, taking 10,000 on first day. And that's showing, well, is that business sort of transacting at that sort of hurdle, right? Are you seeing that performance coming through already? Then the other element, they look at size of the addressable market, right? So how big is the space you're playing in? Is big enough space there? Then they look at product market fit. So product market fit is, have you started seeing that traction? So ARR or seeing revenue coming through is a good example of product market fit. But more than that, you start going into something called, especially in this type of business, if you're going into e-commerce or scaling businesses or technology, there's something called LTV to CAC. So it's lifetime value to cost of acquisition of the customer. And that's when product market fit and scaling start coming together. And I'm going a bit more deeper into technical here. But for example, if you know you can get a customer for X, so let's say you're doing just your own website and it's e-commerce business, and you know you can get a customer for £100 because it costs that much from a cost per Google click, get them to your website, get them to convert, they transacted, it costs you £100 to get that customer. Then the question is, what are you going to sell to that customer? What's the value? And how long is that customer going to stay with you for? Is it a subscription model? So are they going to be signed up for 12 months and they may churn and they fall off? Is it going to be one-off transactions? So you've got to keep remarketing to them and get them back in. But that gives you your value of that customer. So having an idea of that, it may not be complete science, but having a view of that this is my customer profile, whom I'm going to go after. I know they hang out in this area, so it could be on social, it could be bricks and mortar, it could be wherever, but you know where you need to go to get that customer, and you know how much it will cost you to get one of those customers. And then you know what you sell to them, how much value you're going to get. When you have that equation, you sort of know your profit per customer. And that will get better over time because you'll get better acquiring them, you'll probably sell them other stuff. But if you have that view, going to a VC and saying, I know who my customer is, I know where to get them and how much it's going to cost me to get them, and I know what I can sell them something, and this is the value I'm going to get. And now if you give me this money, I'm going to use it to just get more of them. And I'm going to build up my marketing channels, I'm going to work that through, and I'm going to scale that part of the business, and my unit economics of my business will scale in this way. And that's a big fundamental of what a lot of investors look for from a scaling perspective, because they know that you understand your core economics of your business and you know where you're going to drive value from. And they also know where you're going to spend their money. And that, if you're pitching to VCs, a lot of time you might be, well, come back when you've got 1 million ARR, or come back when you've got product market fit. Or you might be in a situation where you don't have any of that, but you just have a bloody good idea, you've got some IP, and you've got some technology, you haven't even figured any of that out. But the space that you're operating is so big, so emerging and unknown, and you've got an innovative way to disrupt that, and that's when founding team comes into play. because I don't have a run rate product yet. I don't know those elements of it, but I've got something pretty good here that I think could work. The team dynamics is really good and the capability is there. So it could be the IP in the team, it could be the founders themselves in terms of their personality. That piece itself might say, I'm going to invest in that because I think you're going to crack it no matter what, and you're a good bet to go into. And you may have executed before as well. So you may have execution credibility because you may have been in a previous company. So from Uber, there's a lot of Uber alumni doing this. Uber ruins you because you can't get that high and that fix from anywhere else. It's just a great rocket ship you're driving and they're launching their own businesses. But that credibility of knowing that they've done that on somebody else's dime is quite good. And that's sort of, gives that validation. And then you're going with an idea that I know how to execute this through. That's when people get in early. So VCs are like, right, I want to back that person and that idea more than the actual business. But if those elements are a little bit more less protected, less moat, it's another area, there are lookalike businesses in there, then they'll look a little bit more, right, all right, how are you actually performing in this segment as it is compared to your peers? Are you doing something better than other companies out there? And they're the sort of, they're some of the feedbacks we get. So we'll go away. We're like, right, let's just keep delivering. Let's keep validating this thing. Let's keep fine-tuning what we call our customer profiles are, who we're getting out to them, and let's show them coming in. We've got more of them coming in. We know that they're converting at this amount. We know they're spending at this amount. Go back and pitch that through and saying, right, look, it's happening. We believe in it. It's growing in this way. This is our projections, and we keep moving that momentum. That's a slower burn. It takes time. It's harder, to get the money in. And then if I get the pitch decks in, and if it's something that I'm very early stage, to be honest with you, it's all gut feeling at that point. It's, do I like the founder? Do I like the team that they're building? Am I passionate about the idea that I'm investing in? And then to be honest with you, it's a bit of a punt, right? You're putting some money in there and seeing what happens, and you're sort of hoping what that sort of concept will come through. And we've got a couple of those, and you try and you work that through because you believe in sort of that concept overall. So I didn't specifically answer, there's no magic bullet here in terms of what do investors look for. It's very different. I mean, all of you are investors in your own right? You're investing you could be investing money, you could be investing in your own opportunities, but you'll be making these conscious decisions on that basis as well. A lot of time it may be based on what you're passionate about and what you believe in, right? And that's your sort of return on investment, is that what you're getting out of it. So and investors think in a very similar way depending on where they're from and what their goals are. But the VC world is pretty harsh at the moment. There is a lot of money out there, but I think how you pitch is knowing who your audience is, what they're looking for, and then based on where you've got your business to in that sort of journey, you can sort of dial it. You can make sure, are you addressing that, right? So if it's not really super disruptive or some innovative technology, but it's an area you're working to, well, you have to show traction. You have to show product market fit. You have to know who your customers you're going after, and you've got to show that sort of type of thinking in there. And if it's super innovative, you've got to know the area you're playing in and how that could work through, and how you and your team are sort of building up to be able to attack that. Hopefully that helps answer some of those points. But yeah, opening up to questions and any thoughts you guys have on what I said.
Very well explained.
Yes.
When you've had somebody reach out, and you say it's like a very gut feeling, but what has been a red flag that pops out, that even if everything else is nicely designed and it's talking about like the scalability that we talked earlier and it's good founding, a red flag that even though it might be small, it just puts you off completely?
Yeah, I've got one right now. Really like the guy. But maybe it's sort of, so it's a really cool concept. It's like Airbnb for office space. So it's hybrid office space working. So hybrid is the hot buzz, and nobody wants to work in the office. Nobody wants to work all the time at home. So where else do you work, right? In your Nero or in your Costa or in your coffee shop. But how can you sort of make a little bit more of a better surrounding, better infrastructure on that? So they're building that up. It's a company called Neighborhood.city, actually Manchester founder. They were backed initially about 120 grand by Antler. So, they had some backing in there. and they are now raising their next round. So it's not that it's a red flag, but it's more, I love, really connected well with the founder, really connected well with what they're trying to do in their business. They've got some initial traction coming through. But when it comes to investing, you do look at who else has invested before you. And I think, the person before also mentioned that, right? You want to show who else has done that due diligence a little bit beforehand. Have they vetted it through? Because if there's something there which has done that, gives you a little bit more comfort before because you've only had a few chats normally, or even had a deck over LinkedIn or something, and that's all you've looked to. So being able to get that first momentum in, but that's always hard, right? Getting that first investor coming in is always a bit more trickier. And that's why it's normally friends and families and people you know. So that helps definitely. What else is there that sort of red flags for me? More, it's just like, again, there's so many that come through that for me, it's anything that I'm more passionate about, and then the individual. That sort of my filter is a big one. Is it a space that I know or enjoy or like? And then that, if it doesn't go well, I feel like I'm investing in something which is something I'm passionate about.
So I've been hearing like exits are really positive. How do you let people know that you exit within your pitch deck? Is that just on your LinkedIn profile, or?
How do you mean? Sorry.
So when you with exits, when you leave a company which has done well, and then you start a new one, and then that is where you say, "Oh, I've got previous exits." How would you show that on your pitch deck? You wouldn't go, "This is my previous."
I think so. Where I've sort of seen it is the founder. There's normally a team slide, which is whoever your co-founder team is or your founder team, and you put your background or your experience there. So it may be previous exits, maybe previous where you've demonstrated, and that's when you can sort of give that sort of roundedness of the team. So, all right, where's the tech coming from? Who's bringing that piece of it? Who's bringing the governance and the due diligence and the ops part of it? Who's maybe bringing the growth part of it? So those elements, and they've got some backstory there as well.
Cool.
If you don't have that, your advisor board, right? So your advisor board can definitely help as well, where you're getting that coaching and that mentorship through. So that's another area you can put it, where you may just be in this particular area, but you've reinforced it by the advisors you've brought into your network, and they may be on sweat equity or they may have invested. That's giving you a little bit of a sounding board in that space, and that always can look good.
Yeah. I was thinking, like, if I'm a part of another startup, but I'm not like a CEO, CTO, I'm just like one of the lead hires, do I still class that as like a position? Or?
Yeah, I mean, I think, that's all execution credibility, right? That you're learning in another space. It's very fluid right now, right? People are hustling, people are doing side jobs, people can be in a startup, but doing sort of their own piece that they're building in the background as well. And I think that's when you're sort of learning and building your own ecosystem.
To what extent does a bad advisory board or the lack of one put off investors?
I think not so much bad, but more where it adds value. Let's put it the other way around. Where it adds weight and it's material is when you've got association back in, right? So it could be that advisor is giving you access into a particular customer group or a particular partnership that will really help you, right? So it's going to fast track that discussion. Or it may be industry insight in that particular area. Or it could be access to capital. That could be one, but normally a bit less so, right? Because you want normally core in your business that's actually helping you refine your product and your pitch. So I think if you can, having that adds more value than not. Yeah, and you want to be careful. You don't want to give, especially if you're giving away equity and sweat equity at that point, you want to make sure it's people that are actually giving you value at that point in that way.
Did you say you've got an e-commerce business as well?
Yeah.
What do you think the main challenges and important things to make that successful?
Product is the biggest challenge at the moment. I think getting hands on supply chain issues at the moment and product issues. The e-commerce business we have is a drop shipping platform. So we actually onboard UK verified suppliers onto the platform. Sellers can come on board, integrate their store, be it Shopify, BigCommerce, Amazon, eBay, and they can list their products without having to actually purchase stock up front. So that's a big challenge right now with e-commerce is getting stock and inventory and housing it, and then the cost element of that. And then the other side is driving demand. Unless you've got a unique way of a follower base or social base or a very clear way of how you're going to be driving organic traffic to your site, that's another chat, because it can get expensive. And that's when you've got to have a good handle on your unit economics. So cost of getting a customer in, how much profit you're making from them, and how it converts, and then the repeat sales that you're sort of seeing maybe coming from that. Yeah.
Yeah, so I have a question regarding like how if like the startup space is like very female, like not dominated, but because I remember when I was in my gap year and I was like in a startup scene like in Cologne, Germany, it was mostly guys, which was, I mean, it's fine, but it didn't really bother me. But it made me, I could see the struggles I have with my co-founder, she's also a female, and it was just there was different treatment sometimes, and it was, I don't know, I think there were different challenges I can't really describe, but they were there in the biases. And I don't know if you're a man, but like how, I mean, if you see like certain like women founders, how do you make sure that they don't get overlooked? Because I've realized that a lot of the funding really goes to any women, female founders. There are also not that many of them. You know, I don't want to say like, oh my God, you know, everyone hates women. No, but it's just, it's still very difficult. So do you have any advice there? Have you been like in contact with a lot of female founders? How do they navigate the spaces?
Yeah, I think it's difficult, and everybody could say that, right? You see beyond that, and you're looking more at the business and the pitch and the opportunity, etc. But I guess wherever there is a bias, that bias probably does lie, and you feel it. And I think just if I've seen how the space is, that's me, how the space has sort of evolved over the last 4 years, there's so much more support there as well. And actually, female founders or female VCs have owned those sort of roles as well, and stepping up further to create even ecosystems to support other female founders to be able to come in, to make that access to capital easier, or not easier, but it make more comfortable in that way. And the advice, and I've just seen even from my network, so many female founders that have launched and coming through. And I think it's a great time, right? I think it's so diverse, and it's diversity is a real positive, a celebrated thing as well, that I think embrace it, right? And I think if people are looking in that way, it's not the right investor for you as well, you know? Because there's also the other way fit, right? That is the investor the right fit for you, versus are you the right fit for the investor? And I think that's sometimes good to know when to say no.
How do you gauge that good founder-investor fit? I guess from both sides, if you can say that.
How can we sort of say it? I think one of the companies I'm in, we get a lot of support from our core investors. They're actually advisors on our board as well. They're always asking the right questions. They're always supporting in the right way. So it's that you feel you've got a good panel there, or a good network there you can go to when you start, because it gets hard. It will get super hard. And you got to know that person, they're not going to tighten the screws and make it harder for you, but they're actually going to help you and enable you to be able to overcome those challenges. And I think, and that's because investing in startups is a big risk, and it's high risky, and people shouldn't do it if they want that return in that way. They should just put it into an ETF or put it into a fund, or do something like that, because you are investing in that person and the opportunity, and you want to do everything you can to help it going through as well. And I think when you get that sort of a dialogue with your investors and those type of questions and that sort of element, and there could be more than just their money, then I think, especially in the early stages, I think that can help you, right? Because you know you're going to get more support than the other round. I think that does change over time as, you know, more institutional investors come in. But again, you can get more supportive ones that are providing advisory network, access to whatever that business needs to be able to scale, to give the business the best chance to be able to succeed. Great.
Being mindful of your time.
Yeah, I think I'm yeah, got maybe a couple more minutes if there's maybe one more question as a closing question, and then I think we're good.
Well, I just wanted to say, like you mentioned, how everybody mentions, apart from that, those like founders, it's also about like the traction and the like product market fit validity up to that pitch. What are the more preferred methods of traction rather than others? Like, would you like prefer to see maybe a sign-up list or a waiting list or revenue? Like, what really jumps out compared to, or really doesn't convince you that there is traction?
I mean, GMV, which is, you know, the top line money coming through, is great, right? Because when you start seeing that coming through, you're actually trading, you're actually running a business, and that may iterate over time, but that's fantastic, right? That's a great way of doing it. I think pre-sign-ups is another interesting one. because you haven't even got your product there, but you've got that engagement in that area and you've already created a buzz. Other ones that haven't got that yet, and there's one actually that did come, which is a money surveying site, which is trying to tap into the Gen Z and saving products for there, and they haven't really transacted yet. And well, they have, but they're sort of through referral deals because they don't have a product that can be converted. They're more creating surveys and education and content and that type of service. So I don't know that market as well, but something that they did, which was quite interesting, they did a TikTok campaign and got a following on TikTok. And they said, I've got 50,000 followers in this space of my target demographic, engaging with my content. And that was quite interesting because, again, it's an untapped area, it's a new area, it's an area people want to get into and some people don't understand. But that was showing a little bit of intent. So I guess it goes back into, again, your model of how your business will work through, and you're solving for elements of it, right? And if you haven't got the whole thing yet, you might show, I've got this part of it done. Now I need a couple of $100,000 or whatever it might be to work on this part of it, and then this, and you're sort of building that up. And that could be very early stages, is where you need that money coming in to help you build that view up. You may be a lot further down, and then your valuation can go up because you've actually proven some of it out. And then when you actually prove that your next step is scaling, again, that's when your valuation goes even further, because that money is now just to help you grow the business, and hence why the sort of stages of the funding journey change as well.
So it's almost like proving that you've been successful in your earlier stage and showing what you want to do going forward.
Yeah, and showing what you're good at, right? In that earlier stages. Which part of it are you delivering? Is it just a good product that people have got a lot of interest in? Or the content that you're creating, people have engaged with? Or is it that you've actually been able to sell it and make a profit? Cool. Good stuff. Thank you.
Thank you so much.
Thank you so much for sharing.
Yeah, my hands are...